It's already in motion right now. While you're watching this, nearly 6 million ounces of deliverable silver just disappeared from the COMEX in a single session. And the same exchange that spent 6 straight months raising margins to suffocate participation just slashed them by more than 20% in one move. Not gradually, not step by step. One cut tonight at the exact moment the physical market is draining faster than it has in years. That sequence is not random. That sequence is a message. And if you do not understand what that message means, you will not understand what happens next. John OG here. Verify the handle, John OG on YouTube. The copycats are still copying the format, copying the data flow, copying the tone, posting NFP discussions a full day before the numbers release, borrowing the vocabulary, borrowing the structure, borrowing the presentation. But copying the surface is easy. Understanding the meaning behind the data is the part that cannot be replicated. And the data exposes that difference every single time. If this channel has been on your watch list and you still have not subscribed, now is the moment to do it. Because what we're covering today does not appear in mainstream financial media. It never has, and it never will. Let's build the full picture, because a lot has shifted since the last video, and this is not the type of market where you can afford to catch up slowly. The CME margin announcement came first. Gold futures margin requirements dropped from roughly 9% down to 7%. Silver futures margins were cut from 18% down to 14%. Platinum margins trimmed as well, now sitting near 13%. All changes taking effect immediately after today's close. But the important context is what came before this move. 6 consecutive margin increases, 6 straight adjustments designed to force leveraged participants out of the market. Hike pushed traders to reduce position sizes. Each increase drained participation. Each step squeezed liquidity from the system. And it worked exactly as designed. Open interest collapsed, volume thinned, weak hands were forced out. Now, with registered silver inventories sitting at levels that should be triggering headlines across financial media, the exchange suddenly makes it cheaper to trade again. A 22% margin reduction in silver in a single move. The margin cut itself is not the real story. The timing is. 2 interpretations exist, and both deserve serious consideration. The first possibility is simple. The exchange wants traders back. Participation has collapsed after months of tightening margin requirements, and the cut is an attempt to rebuild liquidity and restore volume to a market that has gone quiet. The second interpretation is more uncomfortable. Cheaper margin also means cheaper access to short positions at the exact moment when physical squeeze risk is rising to levels not seen in a decade. The people who actually verify the data are not arguing about which explanation is correct, are watching what happens next in positioning reports, because that is where the answer appears. And the physical picture sitting underneath this margin cut is not ambiguous. The latest COMEX report just landed. Another 6 million ounces of registered silver adjusted out of deliverable inventory in a single session. 7 custodians reported simultaneous adjustments: Asahi, Brinks, CNT, Delaware, HSBC, Loomis, StoneX. Registered silver now sits around 81 million ounces. Earlier today, that number was closer to 87 million. Nearly 6 million ounces disappeared in less than 24 hours. The drain is not slowing, it is accelerating. Hold that number in your mind for a moment. 81 million ounces of registered silver available for delivery. Now compare that with what is happening on the other side of the world. Silver withdrawals from the Shanghai Gold Exchange are running almost 3 times higher than the same period last year. Not a seasonal pattern, not a reporting glitch, 3 times higher. For years, people pointing out the gap between paper pricing and physical demand were dismissed as conspiracy theorists. Right now, they are not saying much. They do not need to. The data is speaking for them. Now layer in positioning data, because this is where the structural picture becomes impossible to ignore. Managed money silver longs are sitting near a 20-year low. During this entire price cycle, silver moved from roughly $30 to above $80. Through that entire move, money managers reduced their long exposure by roughly 70%. APR positioning has not been this bearish in 2 decades. Physical demand has not been this tight in 10 years. Those 2 realities are now existing inside the same market. That is not a contradiction. That is a setup. And before anyone interprets that as a guaranteed directional signal, understand something important. Setups do not come with timestamps. Structural imbalances can exist for years before they resolve. The disconnect between physical supply and paper pricing has been building for a long time. Its resolution does not happen in a single session. What it tells you is structure. Timing is a completely different question. Anyone pretending to know the exact timing is selling certainty that does not exist. Now consider another metric that deserves attention. The COMEX gold to silver inventory ratio has now dropped near 1 to 10.7. But the gold to silver price ratio in markets still sits around 61 to 1. Then look at the broader leverage picture. For every single ounce of physical gold sitting inside deliverable inventories, roughly 133 ounces of paper gold trade against it. 133 to 1. The next time gold experiences a sharp paper sell-off while physical demand remains stable, that ratio explains everything. Paper markets can reprice violently when the leverage is that extreme. The physical metal does not change, only the paper price moves. And that brings us to something that traders across the market have been watching closely this week. For 4 consecutive trading sessions, gold sold off sharply at exactly 8 o'clock in the morning Eastern Time. Monday, a drop approaching 3%. Tuesday, more than 4% at one point. Wednesday, nearly 2% again. Thursday, another 2% decline. 4 separate sessions, the exact same timestamp. Across those sessions, roughly $4 trillion in paper gold value repriced lower. Natural selling does not operate on a schedule. Markets do not spontaneously decide to sell at precisely the same minute 4 days in a row. That pattern carries a mechanical signature, an algorithmic one. Anyone who studied similar behavior in Bitcoin markets before regulatory attention forced those patterns to disappear will recognize the structure immediately. Several firms have been mentioned in trader discussions analyzing the pattern. Anyone who studied similar behavior in Bitcoin markets before regulatory attention forced those patterns to disappear will recognize the structure immediately. Several firms have been mentioned in trader discussions analyzing the pattern. Run the charts yourself and draw your own conclusions. And if you are wondering where regulators are during all of this, that question is completely valid. Now, compare that price action with what ETF data shows. Global gold ETFs recorded roughly $5 billion in net inflows during February alone. That marked the 9th straight month of positive flows.